Hi, good evening, everybody. This is Sahil Kapoor. Welcome to another episode of Adding Zeros. I'm your host for today from DSP Mutual Fund. Through Adding Zeros, we bring to you the most relevant and insightful ideas, which can, we hope, help you become a better investor. And today we are discussing banking. As you know, Indian banking sector has weathered many storms. It has seen glorious years of growth and many sobering credit cycles, but it remains one of the mainstays for India's growth path. It's one of the most important sector, so to speak, the backbone for not only India's market, the stock market or the capital market at large, but also the Indian economy. And it's because Indian economy is heavily dependent on banking credit. It meets nearly half of India's incremental financial resources every year. And that's been the case for decades. Although numbers have come down a bit, but banking remains one of the most critical sectors. For the last few years, we've seen banks had to navigate a number of challenges. There has been slower growth, a lot of policy changes, NPA cycles, which have not gone away. It has taken some time. And there has been a fast-paced change in terms of digital landscape. There is a huge technological change which is coming up in the banking sector itself. And if you are an investor, I think banking remains one of the most important sector to track. It is not only one of the highest weighted sector and also one of the biggest, largest representation in the Indian capital market. It also accounts for large, sizable profit pools, in the corporate industry. And historically, I guess there have been very, very few bull markets in India which has sustained without banking leading or participating fully. So I don't remember any large bull market taking shape without banking being the leader or at least a large participant. So it remains a critical function for Indian capital markets and Indian economy. And today when I discuss banking, to discuss this exciting landscape of banking, I have two splendid speakers with me today. We have Mr. Srinivas from Federal Bank. Mr. Shyam Srinivasan is the MD and CEO of Federal Bank. He coined a phrase, digital at the fore and human at the core, which clearly showcases his focus and his philosophy in building the digitalization efforts at Federal Bank. Mr. Srinivas has spent more than 2 decades at leading banks across geographies and is truly the alpha voice when it comes to BFSI industry. And we are very, very privileged to have him here. I think his insights are extremely critical in the industry, and we hope to have a sound understanding of banking industry from him today. Welcome, sir.
Thank you. Thank you.
We also have Mr. Dhaval Gada with us. Dhaval and I have worked together for a long time in the past, and we've known each other for over a decade now. Dhaval comes from a rich experience of more than a decade, and he's been tracking and researching a number of complementary sectors which complements banking, and he's been tracking BFSI very, very closely at DSP Mutual Fund. He's the banking analyst. Previously, he's worked with organizations like Motilal Oswal, Edelweiss, Morgan Stanley, and many others. So I think with this, I welcome both my guest speakers today, and probably we'll directly dive into our topic today, which is banking. And Shyam sir, I would want to start with you. So largely, when I look at a few numbers which are critical, India's non-financial debt to GDP, so to speak, is at about 338 trillion rupees today, which is about 150% of FY22 GDP. And when I look at the core sector debt, which is non-government, non-financial debt, it's also at about 75% of GDP. Very, very large numbers, which tells you that banking is very, very core, or credit is very, very core to India's growth. And when you look at the incremental contribution which comes from banking in terms of every year, what is the incremental credit which comes from bank, the proportion has fallen from about 50% to overall incremental credit every year to about 40%. Banking share has reduced a bit over the last 5 to 7 years. So I want to understand first from you what has happened, why banking credit has been on a slower path over the last 5 to 7 years, and has it now changed? Has this cycle changed? And if not, what will it take to change it? Shyam sir, over to you.
Thank you. And yeah, the data you mentioned is true, but that's actually looking back. every now and then I write an internal blog to the team. This week, the a note was on advantage banks. It's. I really believe that it's at that sort of inflection point where particularly well-run, well-governed banks are going to hugely benefit from the environment that's shaping up. Why do I say that? And in some part answers the question you mentioned. For a long period, last 5-7 years, I would argue even 10 years, the system has had one story or the other breaking out, either induced by the banks themselves or the environment, the economy, or just the rate cycles encouraged credit needs being met by other instruments, right? If you have an international market which is cost of money is 0%, there is a certain degree of gravitation towards borrowing through those. Or if the credit appetite of banks in India have been limited, or their capital capabilities are low, certainly there is a certain degree of migration to other instruments. So I do think if you take a photograph of today versus even say 2-3 years pre-COVID, banks have come to a point where appetite is back, balance sheets are clean, well capitalized. And this I say generically, not just a few. Regulations have become a lot more firmer and tighter. And I usually believe when the regulations are clearer and tighter, it actually fosters growth. So at the point we are in, and not looking at the period that went by, now I don't know if the 40 will immediately become 50%, but certainly the trajectory is changing. And I was mentioning on a call a couple of days ago, I meet the credit committee more often than now than I did 6 months back. We usually have a meeting a week. Now I'm almost doing 2 a week. And that is indicative of the fact that the proposal velocity is picking up. Now, these are early days. One can't quite comment that this is but it's certainly beginning of a trend. And I do believe as CapEx pickup happens, and there are signs that the numerous developments across both locally and driven by the China plus one kind of philosophy that the world is following, there will be a fair amount of credit demand coming up. And as interest rate cycles begin to turn and banking system appetite increases, as the regulations start serving the banks a lot better, my belief is that in the years ahead, you will see some kind of, and I hope without the bad news of the growth that came in 2004 to 10, that era will be back is my feeling. I'm beginning to believe that calendar 22 itself will start seeing some of that kicking in. Maybe calendar 22 may start seeing high teens growth after a long time. And once that happens, then the banking system's capability to serve that is driven by their ability to underwrite and not the availability of credit. It's more their smartness of underwriting credit. So I do think for all the reasons mentioned, which reduced credit in the past period of either induced by the banks or the global situation was a lot more easy money, liquidity, or other instruments, the bond market opportunities that were there, all of them are now in some sense turning in favor of the banking system, particularly for well-regulated, well-capitalized banks. So my belief, you will start seeing this pickup. And there are early signs. I mean, if you see YTD, Y on Y, about 7% growth has happened, which is higher than what it was. So I do see early signs, but let's hope that 22, and this I'm saying, Omicron should not come and put a new spanner in the works. But if you assume that is a manageable event, my sense is 22 should start seeing pickup in credit.
Oh, great. So if I pick up that correctly, you're saying that a number of factors led to slower credit growth, and now many of these factors, which were, let's say, headwinds, they are arrested, and you are seeing a clearer runway ahead. Of course, with some, flags that we don't know right now. But yes, the runway looks much cleaner now in comparison to history. All right. So we'll discuss a lot more in terms of the pointers that you threw right now in terms of capex and other individuals. But I'd like to bring in Dhaval here. Dhaval, what has been the biggest challenge for investors, so to speak, in banking? Banking hasn't been the best performer lately from, I think, pre-COVID, let's say Jan 2020. Largely, it's one of the biggest underperformer in terms of when you look at the returns. So what has led to this underperformance lately? And is it getting arrested?
Yeah. No, yes, the sector has underperformed. I mean, if you sort of take a step back and think from Feb 20 perspective, this was a sector which was most sort of liked by investors, large overweights from investor standpoint. COVID hit us. I mean, there was fear of asset quality, stress. I mean, various estimates, kept on changing. April, July, as each wave came through, we saw, estimates being revised initially significantly more conservatively. At the time there was positive, sort of moment on the asset quality expectation of lenders, and then subsequently, I mean, if you look at then the relative standpoint, we entered the pandemic with about 7-8% credit growth. Even today we are about 7-8%, 7% odd credit growth. So from that perspective, relatively as well. On growth, other sectors, scored better, and that was one more reason why financials was less preferred in this period. And last point is, some of the new age IPOs that have come through, which have attracted investor capital. So going into 22, I think when I look at the sector, I think it's one of the best point I would think after a long time where we have, like Shyam sir mentioned, improving credit growth trends, better asset quality outcomes likely, and very reasonable valuation. So I think we could be seeing a very good 2022 for financials, and a good part of this underperformance should get covered or be even alpha generating.
Right. So Dhaval, if I get you correctly, I think Shyam sir and you are painting a very similar picture, saying that there is a clearer runway ahead from valuations perspective or from growth perspective, both probably coming back. And it does look like there is a better chance of doing better in FY22, in FY23 and onwards. So let me deep dive into some of the key aspects here. And Shyam, I'll come to you on this one. When you look at banking as a whole, I think last few years we've seen, particularly after the IL&FS fiasco, we saw that a lot of banks focused on retail lending. And so before the recent wave of NPAs, mostly it was the corporate credit cycle which was a problem, which drove NPAs upwards. But for the last few years, we've seen unsecured retail credit that has seen, one, tremendous growth and also a lot of NPAs now. Credit cards and personal loans, CCPL category, has seen huge NPAs. So what are banks doing to tackle that? Is it a red flag, or is it something which will be easily tackled going ahead? And has the ship gotten too crowded towards the retail portfolio and probably tilting again? Is it a red flag that you're watching?
I think these things do tend to have cycles, right? I mean, when something is down, people give excessive focus, particularly when liquidity is high and you didn't see much pickup in corporate. There was a heavy pivoting to retail. So every bank and its neighbors started moving it. It also is the same time that the sort of plethora of NBFC and fintechs all kicked in. So retail became flavor of the day. Not became, is flavor of the day. But if you really step back and see the India story, everybody believes we are under-penetrated from a credit point of view. In any measure as a percentage of GDP, you can argue that it's lower credit offtake. So there is certainly going to be a demand. And if you start believing that the 7 to 8% GDP growth rate is sustainable over a 3-5 year period, which is almost imperative for all the developmental initiatives that we're seeking out, then the retail credit growth doesn't worry me. Right? It is must. Job creation and more younger people coming into the workforce is going to happen. Now, if we see some parts of the portfolio of some banks, I don't think it's a generic issue, because the very large issuers of credit are not seeing as much pain as some of the players, and therefore it points not so much as the industry issue, more an individual or a cohort of banks have probably used filters differently or have been less efficient. I think with the emergence of bureaus, certainly, I mean, for sure, people are extremely more sensitive about their credit rating. Nobody wants to be on the wrong side of the bureau because they realize, particularly the younger crowd, realize that their long-term credit borrowing is going to be impaired. So I think the spike that you see is more a point in time. To my mind, it's not going to be a sort of a deep endemic issue. That said, yes, there could be institutions who may have had some elements which have been probably more ambitious, less rigorously underwritten. But if you've seen the very big players, I don't see them seeing any untoward plan. Yeah, unsecured credit will have higher share of delinquencies and potentially losses, but that's par for the course. I mean, when you charge rates which are much higher, then you're expecting that to happen. So I think retail credit growth, everything, of course, is what kind of credit growth in India is seeing. But if we are seeing 7-8% GDP growth with all the buoyancy that is beginning to show up as COVID begins to taper down, so to say, I am convinced that retail pickup is not fluff. It will sustain. But in everything, in these things, one has to be extremely careful, right? You can't believe that it's free for all. It will distinguish good players versus not good players. That's why I keep saying advantage banks who are well governed and well run. If you are running it well without being kind of heady and being reckless, I think this is going to be a big period for big growth opportunity, and retail in particular, for all the reasons mentioned, will see pickup. And the bureau and technology is both enabling and controlling, as an enabling for growth, but it also has so many opportunities to apprehend the customer who tends to go off, is sort of reluctant to pay. If there's a massive job loss and retrenchment and so on, yes, there could be challenges. Otherwise, what you see right now is not something that, as of now, I don't see major red flags.
So you were saying that probably retail credit is not a fluff. I think it's a cycle which probably has more legs. And so when you look at the, let's say, bottom of the pyramid, an argument made often, that MSME are still under stress, recovering from COVID. Job losses at the bottom of the economy are still severe, not recovered fully. Do you think that makes any difference to formal bank lending, or is that segment still small enough not to impact overall numbers?
No, there is going to be some impact, but again, it's all relative. From having seen losses of big tickets and those are stabilizing, you will see the other side of the story also beginning to show up, but I don't think it'll dramatically shift the needle. One. Second, I think the organized sector, which is what largely the banks are addressing, is not seeing as much stress as the unorganized sector. So to some extent, the job losses, the smaller businesses suffering, I'm not denying that's not true, but I don't see it actually play out in the balance sheet of banks as much as what you hear and see are people suffering. Right? To that extent, the organized sector. Now, the big challenge for all of us as the desire is to make it inclusive, bring it into the banking system. That is what is probably getting delayed. And that's something that is unfortunately impacted by COVID and the losses of jobs and the unorganized sector getting impaired. But you will not see that play out. And that's why Q2, if it's any reflection, at a banking system level, you didn't see any major stress, except one or two banks which have heavy focus on either microfinance or the relatively unorganized segment, right? That's what saw maximum stress. And I would believe that there are many initiatives to support that, but that cannot be, even if it were to be a problem, the size of that problem is not anything of scale that will derail the entire big journey that we're all looking to do and accomplish and growth. So I would think I'm not dismissing the problem, but it's not huge or disproportionate to the challenge and the opportunity on hand.
Right. So I can hear the words, penetration, credit appraisal, growth. I think all these are very supportive for retail credit cycle. And as you said, initially you mentioned that it appears that we might be heading for 2004 kind of a cycle, and which brings me to the other aspect, which is very critical, which is the overall capex cycle. Generally banks are the first one to know, as corporates generally come to you first, for a credit in terms of large capex whenever it happens. Although the complexion of capex might be different this time, but I think still banks are well placed to understand what's happening. And recently, two of the largest private sector banks said that they still don't see the capex cycle coming soon. It may take some more time. How do you see this? What is your expectation? And do you think that the amount of capex that the government is promising and the pink of health in terms of some corporate balance sheet on the industrial sector, does it give you any indication that capex cycle is upon us quickly than many other believe?
I think yes. I mean, government spending has picked up on capex. The demand growth that is beginning to show on the consumer and the pipelines getting used up. If not in Q1 of calendar 22, Q2 of calendar 22, you're going to see that come up. And there are early signs. I mean, I mentioned a while back, we are seeing more proposals now than we saw, more times we meet to discuss credit proposals. And many of them are from manufacturing, which was not the trend. It was typically an NBFC takeover or a LRD. So you're seeing proposal nature shift. So that indicates. Second is, if you go back and look at, we're talking of 100 lakh crores of national pipeline for infra that is being talked about. Now, I'm assuming that will be the next 5-year plan. But the last 5 years, infra spend was about 50,000 crores.
Right.
So you're talking of this being 2x. Now, assuming that it's not 2x and it's going to be 1.5x, that's still a meaningful demand creation that will happen, right? As these things happen. If some of the proposed plans around electricity sector because if growth has to happen, that sector has to see a lot more liberalization. Go back, what happened in power generation can happen in power distribution. If power distribution gets sorted, you can imagine the kind of demand that will crop up. If the alternate energy that we're talking of kicks in. So all these are, of course, I'm putting on very positive lens because I do believe over a period of time, having seen a lot of pain over the last 8-10 years, there must be some light at the end of the tunnel, and it's beginning to seem like, we had a caveat, COVID doesn't do too much wreck here on. I think the promises are quite possible. Yeah, it could delay by a year, but certainly not forever. So you could believe that 22, now which part of 22 one could argue, but there is going to be pickup in capex, capacity utilization, balance sheets of both corporates and banks are in good place. Demand seems to be picking up. And invariably, if you're seeing good retail demand for property, for vehicles, one can argue is because of a chip problem or whatever, I can't quite tell. But you are seeing then the upstream manufacturing has to pick up.
Right.
And at this juncture, looks more optimistic than it did 2 quarters back. And I'm hoping that the promises made by both the government and the private sector all are going to be executed. So you can see pickup.
Sure. Shyam, we've seen that industry, credit towards industry has been, abysmal over the last 10 years. There has been absolutely hardly any growth. Adjusted for inflation, I think it will be negative growth overall. And services continues to dominate, even in terms of, credit. When you spoke about sectors like manufacturing, vehicles, and do you think that this time the capex orientation is different? Can you sense something like is this capex more brownfield? Is it more, let's say, when you look at credit, is it more working capital credit? Is it more logical versus the cycle that we had last time. So do you think this cycle could be shallower but longer? I mean, it may not go to 20% credit growth, but remain maybe at 10-12%, but continue for a longer period of time. Is that something which is a current assumption?
Yeah, I mean, for the reasons, if we are assuming 8 or higher rate of GDP, if we are assuming that you want to make the country more sort of modern and the development is inclusive, then without infrastructural development, this is not going to happen, right? And the projects promised are all infrastructural development. The reforms that we're talking are all in that space, whether it's electricity, power, alternate energy, all of them are indicative of the fact that these are, and the China Plus One, the PLI schemes, the bunch of stuff that we are talking of are all indicative of the fact that there should be a meaningful investment in capacity creation. And I also, very anecdotally, if I take 5 proposals that come from, say, Bangalore, almost all 5 would be LRD or NBFC. Now, at least 2 of them are manufacturing.
Right.
So, when an LRD here is indicative of services growth, because Morgan Stanley was recruiting 100,000 people and parking them, or IBM was. Now you're talking of manufacturing. So, I can't take 2 data points and project it for eternity, but one has to tie in a lot of data, and it begins to indicate that there is, sadly, there's in the horizon, there is some scope for these things to happen. 2 quarters out, it may get clearer. 1 year out, it will get clearer. But it looks a lot more encouraging than it was,
sure.
In the heat of COVID, pre-COVID.
Right. Got that. So I think, Dhaval, next question is to you. Retail and probably corporate cycle both are looking at least better than what they were for the last 5 years. And the runway looks cleaner. I want to understand how the profit pool is shaping up. How were they, let's say, before COVID hit us? How were they shaping up over the last 10 years? And what are the numbers that we are looking forward to in the next few years?
Yeah. So, interesting, sort of points I can share is in terms of, and this exercise we did at the start of the year. So if you look at lending space, so there's bank, all put together, the profit pool peaked somewhere in FY15. Roughly 1.5 lakh crore was a profit pool for lending system. Then over the next, and this pool was growing about 18% CAGR for the preceding 9-10 years. So that was a growth of the profit pool. This included one retail cycle as well. Then in the next 4 years, the pool went down almost 80% to about 30,000 crores between FY15 to 19. This number went up almost 3x in FY20. And my sense is FY21 data RBI has not put out yet, but my sense is this would be another 50 to 100% growth on FY20 base. So basically, we have moved back to FY15, close to FY15 level, the peak profit pool in FY21. And in this interim period, we would have at least grown the book by about 50% in the last 5 odd years. We would have grown the asset base by about at least 50%. So I would expect this number to grow substantially in FY22 and 23, and thereafter go back to the asset growth that we see, which could be in the teens, like Shyam sir mentioned. So that would be my guesstimate of how the profit pool is likely to move. So a very sharp acceleration in FY22 and 23, and thereafter, chugging along close to asset growth. So that would be the expectation.
Sure. Shyam sir, coming back to you, I think story for the last few years has been market share gains for some of the few top private banks, and industry as a whole has been more or less stagnant, roughly, right? And next 5 years, do you think that both these aspects grow together? That means industry also grows, but market share of private banks continues to go up, or is there a case for a more equitable kind of a growth? And market share gains could be arrested?
I'll tell you one thing. Increasingly, the definition between private sector and public sector will start changing. Right? In a year or two, if more public sector becomes private sector, suddenly the whole the scenario changes. So your denominator itself changes. But I would again point to the fact that we should get less, it should be less ownership agnostic. And that era is over in my judgment. It will be around who is well run and who is well capitalized. So if you use private sector as a proxy for that, yes, you will see private sector doing way better. But I am arguing an SBI is no less, or some of the other well-run public sector is no less. So we should not look at that. But will share gain come to the better run? 150%, yes. See the point which you guys know better. India is a heavily fragmented banking market. 50% is held by 7 to 8 players. Another 50% is held by 22 players, all in the 2, 3, 4%. Right? There is in a very classic case, in an unregulated industry, is the best case for consolidation. If you go back to a classic Porter model, that's what typically they teach you, right? Maybe in an unregulated industry where there is a heavy fragmentation, somebody has to consolidate. But in a very regulated industry, that's not possible. So the next best, when it's not possible to consolidate, is somebody has to step up and gain share. And who will gain share? The guy who is well run, who is well capitalized, who has less baggage is going to gain share. As you've seen in the last 5 years, I am convinced the better run, less. And I also mentioned at the top of the meeting that the regulations are now that much more clearer, that the guardrails. And if you play within that, I am convinced good players will gain share. And you will see that happen. It's already happening and it will happen at scale.
Sure. One follow-up question, Shyam. We spoke about that there are a lot of other avenues which probably ate up some, market share for credit, like the bond market or international borrowings, ECB, etc. And there is also one more aspect, which is where corporate balance sheets are much more stronger today. In light of what has happened over the last 20 months or 24 months, and it is both a risk and opportunity for banking. How do you see this? So they have more options to borrow today than they had 5 years ago. Plus, I think they have stronger balance sheet. Does it make any difference to the banking industry as a whole?
No, I think it's pro-bank, as in they will come to banks because if their balance sheets are good, demand is picking up, capacity utilization is 75-80%, they're certainly going to look at new investments. And if they're going to do new capex and the earlier disintermediation that had happened is slowly evaporating, they will come to banks. So banks with appetite, banks with good capabilities will pick share. I mean, we'll be happy to do it. And I think pointers are that it will come. And yeah, these things don't happen overnight, but the trajectory you will start seeing, early part of 22 and beyond. And the stronger balance sheets, more demand, well capitalized, investments ahead of schedule. If you see 23 is going to look good for India for all the right reasons, you will start seeing good names investing in 22 and building capacity.
Right. So I think there are some tactical questions which are very, very important today. And I'll quote Jamie Dimon, who said that banks are facing extensive competition from Silicon Valley, both in form of fintechs and big tech companies. And that is here to stay. So what do you think, how much of a threat are neobanks, and how are they shaping up according to you? Because they have very, very different cost structures, and these new age banks and fintechs that are coming up now versus the traditional banks. So what are the traditional banks, so to speak, are doing to compete with them? And do you think that there is going to be a partnership, or there is going to be a sabotaging of the turf between these two players?
No, I can speak for our bank, and I'm guessing many may be pursuing that. We have for quite some time, and now even more visibly so, we are a massive believer in collaborating and working with fintech. As you know, we've got probably the only bank that has 2 neobank partnerships. We are working with all the good fintechs in some capacity or other. The key point in my mind is that, and you mentioned at the beginning when you said our mantra is digital at the fore, human at the core.
Yes.
We have invested in the technology capability that can make sure that the plug and play with the fintech is relatively easier. It's not like a on-off switch, but the integration is a lot easier. And with that being the capability, the fintech is also keen to work with us because they see what do they need? They need a banking platform. What do we need? We need distribution, right? So it's a very happy marriage. Now, that's the collaboration part. Now, if you find a good revenue sharing capability, then it's something that will work well. Now, does it mean forever and a day this will last? I don't know. Right now, the regulations are not permitting any of them to do everything by themselves.
Right.
Now, the day the regulations change, but the indications are that is unlikely to happen in a hurry in our country, right? I mean,
Right.
so the fintechs need the banks, then banks need the fintechs. Sometimes we are ahead, sometimes they are ahead. If you're wise about it, you will choose the partnership sensibly and progress. So I am not, at least for my bank, I'm certainly not alarmed. We are welcoming it and we are happily embracing this and working very intensely with the names we are working on, and it's going well. Volumes are picking up, and of course there are teething issues, and you learn as you go. There's no textbook written on this, so everybody is sort of moving ahead. There's the good news from what you said of Jamie Dimon or many of the Western countries is that they cannot operate standalone in India, which is the regulatory benefit that the banks have, and I hope it lasts forever, as long as it is done wisely by integrating the two. And that's something that we should leverage. Second, in doing work with them, the biggest benefit is if I'm going to deliver for my fintech originated customer a certain degree of service and speed, I should do it for my bank originated channel also. So my core banking platform is getting sharply refined to become better and operate at the same speed or better. So there are many advantages of these partnerships. Of course, these are time taking and a lot of senior level attention is required. But done well, it raises the game very heavily. So I, for one, believe that this is a good development. We believe in it as a bank. We've invested or investing heavily in the model of engagement. Very senior level people of our bank are involved, and not just the front end, compliance, control, risk, back office, middle office. We are creating actually a bank within a bank to engage with this.
Sure. Shyam, I'll also come to UPI and talk about it, but I want to had a vision kind of a question for you. When we, let's say, look at banking 15 years ago or 10 years ago, it was mostly branch banking, right? And now, as you said, that banks enjoy an entry barrier. Other players cannot really come and take up the turf easily. There is a regulatory entry barrier in banking today. And as you said, collaboration is the key with new fintechs. They are coming up. What do you think will be the shape of a bank let's say, in 2025 or 2030? Will it be a fully digital banking where there is hardly any physical interface? Or do you think it is still going to be a very, very fusion kind of a banking where all models will exist?
One of our other mantras is branch-light, distribution heavy. Right? We decided not to add branches, but we decided to add distribution. And distribution here is feet on street, RM, digital, every other non-physical part, which we've been doing. But we must keep in mind the good and bad part of India is we are not one homogeneous mix, right? Everybody is not Sahil or Shyam,
yes.
Right? We've got the person who works at Sahil's house or lives in the village. And again, the divide is not just economic or age, the divide is also digital. And digital doesn't mean that the guy in village doesn't know how to use digital. The guy in the city also may not know. So I think it's the digital evolution on one axis and the economic or any other measure you use on the other axis. You will find to meet this large cohort of people of different dimensions in both the axis or the four quadrants, India's banking system will not evaporate to completely digital. You may have multiple, but the accent will shift in such a way that there will be a lot more technology enabled at all levels. So to that extent, the cost to deliver may come down. But I am of the view that human touch or the need for engagement will not get diminished, but it will change texture, advisory and stuff like that. So 15 years out, I mean, many questions asked us this question 10 years back, right? We said that over 10 years this will happen. Who believed that this would be the new bank? And none of us believed in any fashion. So I think 5 years out, 10 years out, this or its next variant could be the prominent channel. But it's not like a demise of banks in a totality. It's the nature of form and shape may change, right? But if we keep in mind foreseeable future, by 2030, I will be 70 years old and I won't know what the hell, right? But I can quite visualize that the quadrant that we mentioned, between digital and digital awareness and economic or other banking awareness, so to say, you will need many types of people to be met and served and needs to be served. So banks will morph itself to meet all those needs.
Sure.
Dhaval,
sorry.
Go ahead.
Dhaval, one question to you in terms of, let's say, numbers and economics. What do you think? How is the fintech risk likely to play out for banks? Is there going to be any margin pressure? Are NIMs going to be under stress? What is your assessment?
So on fintech, we did this study end of last year, to assess in some of the Western markets and even China, for example, how this has played out, where they're slightly ahead compared to India in terms of evolution on fintech. What we learned is the first leg, it expands the market. So the traditional lenders, actually they grow faster than what they were doing before the fintech risk came into picture. So it initially leads to market expansion, which is logical because the customer segment that some of these companies target are beyond the traditional leg one banking that we see before the risk evolved. So there is expansion of market. Then I think subsequently the risk that we assess, and that is our estimate, that there will be two pockets where the risk will evolve. One is on fee income. So the cost of distribution of financial product, of generating loans, they would be far more efficient in a digital form compared to the traditional form. So fee income would be one place to watch out for. Directionally, we would have seen in Indian banks fee to asset trend lower over years. So that is one place to watch out for. The other risk would be on the unsecured credit, especially the transactional credit, where traditionally people used to prefer personal loans, long tenure, medium tenure personal loans. Now there will be transactional level credit, distribution, which will happen through products like BNPL and pay later products, and other short tenure form of credit. So those are the two areas where I think banks need to protect the turf, and I think initially it will expand the market. And one other thing which you pointed on NIM. So on NIMs, actually, one of the strong advantages that banks have is the funding franchise. We've seen that if you see India's wave of fintech evolution, we started this journey somewhere in 2013-14. It's been almost 6-7 years. Wallet companies came into picture, PPI and all other payment products came into picture. And what we observed is even small finance bank, we saw multiple licensing regime in this period. The saving and low cost deposit culture still remained, it was largely protected and kept on growing with the traditional banks, so to speak. So the pool doesn't move, which means that the low cost funding franchise which banks have, and it's been the share has been only increasing in the last 5 years. The CASA share has been only increasing. So that is the one big advantage which will help banks to protect margins, is our expectation. And also the mix shift that is happening from relatively lower yielding assets to more better yielding assets. So that should also help in terms of margin. So I think our view is that margins will remain steady. Also, one tactical bit is last point would be that in the last 6 quarters we would have seen a higher share of GSEC and liquidity instruments, which should unwind in the next year or so, as credit offtake improves, as liquidity starts to normalize. So that should also help margins. So yeah, I think overall very constructive on margins.
Sure. Shyam, coming back to you, why I asked the NIM question on margins is that when you look at various industries, for example, when you look at banking, or let's say when you look at automobiles, they are threatened by new electric vehicles, right? When you look at oil and gas, threatened by new sustainable energy, green renewable energy. Most sectors are facing challenges from new technologies, right? And when you look at banking and finance, I think a new contender on the block is decentralized ledger or cryptocurrencies or central bank digital currencies, right? And when you put a central bank digital currency at one end, put a bureau or a credit appraiser at another end, and also put fintech in the same field, how much of turf will they cover, which banks covers today, and will it cause any erosion in the kind of profitability that banks have enjoyed in India over the last 2 decades?
Yeah, I think again the P&L dynamics will change, but the pools may not change. See, as technology evolves and credit standards improve across, I'm not talking of a particular player, across the system, your credit costs will start moderating. Since we compare everything to the Western world and say that, this kind of 100 basis point plus credit cost is not of course, there are seasons when it happens, but the most advanced markets on a sustained period during, say, happy cycles, credit costs are way lower, right? So your profit pools are influenced by margin, costs, credit costs. So the dynamic can change, right? So I would argue that we should not get fussed around only margins. I know we are all heavily growth and margin focused, not wrong, but I think the better way to look at it is a mix, profit pool and returns. That's my view. Second, I think for a long period, I visualize the things that we fear as crypto and fintech and everybody taking away business is less likely as long as at the core of it, you need a banking platform, which seems to be the state of play in our country. Now, regulators may be sharp and harsh on those who are less governed or less sensible about how they govern themselves. They may get less privileges. I see a day when the regulator permits based on privileges, based on your conduct and goodness of how you run your franchise.
Right.
And if you're doing that well, and that's why I keep saying advantage banks that are well run, you're going to see reap rich rewards in this new construct of crypto, blockchain, fintech, bureau, name it. It will all come together for institutions that are both have their antenna out for that, have configured for that, and have the best management practices that ensure that you are leveraging this. If you do this well, and if you truly are slave to data and analytics and so on and so forth, many of your cost dynamics starts change. I mean, not only operating cost, your credit cost. Then you're able to do business at a different revenue model. So, of course, some part of what I'm saying is theoretical because it's yet to be in practice, but you can see this happening. At least that's my vision for the period ahead.
Sure. Just taking a leap from what you said, does it also indicate there is going to be more M&A activity and more non-traditional player, coming and entering banking over time? Because the point that you raised on discipline, is that possible in the future?
I think certainly there will be more partnerships. Now, I don't know if it's maturing into a full relationship or, ownership change, but massive partnership is, I don't think you can escape it because no one institution can have it all. Right? Particularly if you're an entrenched large organization, there are practices, and however much you try to modernize, there is some legacy and there is some core infra that is embedded. So you need to keep doing various front-end innovations to get the best of the both. So I think partnerships will be consolidations, mergers. Will it happen? I think it may happen. I'm not saying no. Like I said, in a very fragmented industry, it's a business 101 to do that. But whether it can happen in a highly regulated environment, licensed environment, I'm not that sure.
Sure. Great. Shyam, we've all been, speaking about financialization of saving as a theme for a very long time now, probably. I think it has accelerated a lot. And when you look at what has happened recently, a lot of savings have been channelized into, let's say, the equity markets. A lot of savings have gone to mutual funds and the new age investments. What do you think banks are doing to counter this trend? And does this change the, let's say, the funding that banks get from very low cost CASA? And is it something that banks are cognizant and developing new products about?
Yeah, I think it's been a challenge for quite some time and it will continue to be. Again, we should not look at CASA alone. We should look at deposits, cost of deposits, right? I mean, I think to some extent we are all fixated by CASA because it assumes SA is cheap and CA is zero, and there are banks which pay 6% also, right? So it's not, it's lower than some term deposits are lower than that savings rate. So I think we should look at the blended cost of money and how much you are able to get from customers and not buy at bulk, right? So that is a fairly sensible management of liability profile. But that said, unless you get more customers, you're not going to get more CASA because same customer cannot endlessly keep giving you the savings. Everybody has everybody matures at one point in time. It's not going to be an endless growth. So you have to look at expansion. And expansion is, like we spoke about, can come through geographic penetration, segmental penetration, a bunch of stuff, which is where I think this whole neobank partnerships are explosive. I did mention in our investor call 2-3 weeks back, a month back, that if you were doing X by ourselves, now we're doing 3X in our partnerships. Of course, these will take time to mature, but you're able to bring a huge number of people into the system now, whether they're first-time customers or they're doing multiple banks. We'll see. Some will filter out, there'll be a churn. But these explosive digital acquisition modes are going to bring a lot more people into the banking system. And over time, they will build their balances. So in the banking system, will the balance build happen organically just by our core base? And it's not possible. It will grow. Everything has certain growth rate. And beyond that, it starts moderating. So you need more new. And the more new is going to come through all these partnerships. And both geographically, segmentally, and in hopefully a growing economy, this will keep growing. So I'm not nervous that it will not grow, but I am saying that the shape of a growth will change. Second, we should not look at only CASA in the traditional sense. We should look at how do you do your deposit cost structure in a manner that it gives you a reasonable spread to lend. Right. And yes, that's why I keep saying the revenue pool and the profit pools dynamics will change. Now, I know the Dhavals and the investor community may think I'm buying anticipatory big, but I think it will change, and it is good change in my judgment.
Sure. One question on risk. I think microfinance, as you mentioned initially in your initial comments, has come about as a risk in the at least in the last 2 years. So what's happening there? Is it a larger risk that banking should be very cognizant or it's a pocket which is probably we'll have to tackle?
Yeah, well, these are all cyclic, right? We've heard if you take 10, 12 years, microfinance has had boom and bust. Either it's because of some state's decision or an economic situation or demonetization or whatever. So the only point here is they're more susceptible, right? The level of vulnerability in that portfolio is usually higher. But if you're sensitive to it and growing it in a manner that it is not dominating your bank's portfolio, I think it should be okay. So I would say it's a very bespoke bank level strategy as opposed to an industry level. Will microfinance face challenges? By the nature of what that business is, it is going to face. It's faced by weathered economic natural disaster, anything can affect it, right? Or some political upheaval, it will have its own consequences. But if it's X percentage of your book, and you can manage.
Sure. One last question to both of you. Dhaval, coming to you first. When I look at certain economic indicators, look at GST numbers, PMIs, all of them are normalizing. And, profit pools have already jumped. They are generally followed by stronger credit growth. Plus, when I also look at the LAF window, reverse repo volumes have come off. And we are right now at closer to 7% YOY credit growth. What do you think will be the number for FY23? We are already at a 5-decade low in FY22. Where do we go and recover back to? What kind of numbers?
So, my estimate is about 12-13% in FY23.
Sure. Shyam sir, what do you think? Do we settle there? Or
I was a little more generous. I said mid-teens. I think it's possible.
Mid-teens. And do you think that complexion will be driven by a homogeneous growth everywhere, retail and corporate, as you said earlier?
Yeah, I think so.
Okay, all right.
But I won't start drawing lines saying that's how it will be for long periods of time. But I do see FY23 looking at that kind of credit growth. Again, we have to caveat everything. We don't know the immediate impact of Omicron, how we pronounce it. It shouldn't cause too much damage. But if it doesn't, I think it's logical to assume good growth.
Sure. Shyam sir, any closing comments from you, particularly about, let's say, over the next 5 years? I think last 5 years, as you said, a lot of noises, a lot of red flags. Next 5 years, you're saying a cleaner runway ahead. So in terms of opportunity size per se, do you think that we can go back to 2004 kind of a cycle? Your initial comment on that was there. So do you think that kind of a cycle could come back?
I think growth is going to come. His visual is visible. But I think we should be mindful that the profit pools will grow, but the mix of everything will start changing. You can't extrapolate the past period to the future because data and technology and maturity of markets is causing behavioral change, which is visible to some, not obvious to everybody, but it is fundamental, and that change has happened. That train cannot be stopped. So if you understand that, then you have to configure our business models to meet those and achieve those. But growth. Unlikely it will get derailed.
Sure, great. So I think that was my last question. So just to summarize what we discussed today, I think it is quite clear that both our speakers believe that there is a good cleaner runway ahead. Both parts of the banking system in terms of credit growth, whether it is retail or corporate, I think both are coming along well and probably will progress much better. Growth is coming back. And I think there is a certain sense of margin of safety here in terms of how the growth dynamics for banking is shaping up. I think I'll close it here in terms of questions today. Great word of thanks to Mr. Shyam Srinivasan to find time for us today. Thank you very much, sir, for your time today and giving us very, very valuable insights. Thank you, Dhaval, for connecting and giving us all the numbers and details today. So with this, we'll close today. Thanks a lot, everybody who's joined us today. We'll come back to you again.
Thank you, guys. All the best. Stay safe. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.